Hello everyone and welcome to TBS Financial Channel. Today we will have the pleasure to talk about the debt market. And many people when they talk about debt, they just think we are talking about borrowing money from a bank, which is true, but it's not fully true as we can have corporation and government borrowing money also on the debt market to fund their development. So let's try to understand what this debt market is about. Debt market is the place where we issue and trade debt instruments such as bills, such as notes, bonds, mortgages, and could be for a fixed or floating payment to the investors at maturity. By the way, maturity is the key word in this financial market, the debt market, because depending on the maturity, you can have a short-term market, which is called the money market, or a long-term market, which we call the bond market. So let's see what's the difference between money market and bond market. So as I just said, the money market is the market where we issue debt for a short period. In general, it's less than 1 year, but depending on how developed the market, be more less than 2 or 3 years, like in the United States. And in this kind of market, the money market, depending on the issuer, we have different financial instruments. If the issuer is the government, we call them treasury bills. These are instruments issued by the government for in general less than 1 year to fund some of their cash flow needs. The other important instrument that involves treasury bills is what we call repos. And repos is a short for repurchase agreements. So that's why we call them repos. Repos are agreements between two banks, a bank that needs some cash immediately on the short term, and a bank that wants to invest and get some returns on the short term, where the bank needing the cash will sell the treasury bills to the other bank and get this cash with the commitment and the agreement to buy it back within a short period. And that's why it's a repurchase agreement, because they commit to buy it back. So these are the two main instruments for the government. Then if the issuer is a corporation, they issue what we call commercial papers. So commercial papers are money market instruments that are issued by corporation. Now, if the issuer is a bank, we have three categories of instruments. We have what we call certificate of deposit. So certificate of deposit is a product offered by banks or credit unions that provides an interest rate premium in exchange of customer agreeing to leave a lump sum deposit for a predetermined period. So certificate deposit, we call them general CDs. The other instrument that is issued by a bank is what we call banker's acceptance, BA, banker's acceptance, which is a short-term loan that is guaranteed by a bank. Now, the third instrument by a bank is what we call euro dollars, which is the name a little bit confusing because you might think it looks like a euro or it's a dollar. Euro dollars are basically deposits in dollar term, but done by foreign banks. So anything that is held, let's say, by a bank based in London or in Germany, but in dollar terms or a short-term security is called euro dollars. So this is the third instrument for the money market. So in a nutshell, let me summarize quickly. The money market is the debt market for a short-term period, and depending on the issuer, you can have different categories. If it's a government, it's treasury bills or repos. If it's a corporation, it's commercial paper. And if it's a bank, will be a certificate of deposit, banker's acceptance, or euro dollars. I hope this is clear. Now, on the other hand, we have what we call the bond market, which, as I said earlier, it's the part of the debt market that is a longer term, very developed in many countries like in the United States. And by the way, the United States is the market that is dominating both bond and money market. It accounts roughly for 40% of the global market. Now, in the bond market, there is what we call the primary market and the secondary market. The primary market is frequently referred as the new issuance market. In the primary market, the only seller that you can have for the bonds is the issuer. The issuer, which could be corporation, could be government, we'll see the different categories, is the only one who can sell the bonds. Okay? So it's a relationship between the issuers and the buyers of the bonds. In the secondary market, it's the market where we trade securities that are already being sold by the issuers. So the seller could be somebody who already bought the bonds in the primary market and selling to somebody else. You know, he can do it through a broker who acts as an intermediary, or he can do it through any exchange that trades bonds markets. As we said for the money market, the same reasoning In the bond market, depending on the issuer, we will have different categories of bonds. If the issuer is a corporation, we call them corporate bonds. So corporate bonds are issued by companies. They are looking to fund their investments, to fund their operations, to do some opening new manufacturing, etc., etc., etc. facilities. Government bonds are bonds issued by the government, in general to support government spending and obligations. They're considered as low-risk investments because they are backed by the government. Now, there is something similar to the government bonds, but they are not quite. It's what we call municipal bonds. We call them munis. So muni bonds are bonds that are issued by entities that they are at the state level or at the district level or at the city level, such as special purpose districts, public districts, etc., in general to fund some investments in facilities at a local level. So it could be like a local stadium, a local theater, anything that is on the municipal level. Finally, we have the famous mortgage-backed securities bond. You probably heard about this during the crisis with the collateralized debt obligation CDOs, collateralized loan obligation CLOs. So these are bonds that consist of pooled mortgages on real estate properties, and they are locked in by the pledge of a particular collateralized asset. So in a nutshell, these bonds are a pool of many small loans of people who borrowed money from the banks to buy houses. So the investor in this bond, he gets his return and his coupons, and we will see in a later video, from the payments of any borrower of the housing market. This is in a nutshell what's the mortgage-backed securities bonds. This was a quick overview concerning the debt market, and see you soon on TBS Financial Channel.